Very much welcome to GAC Presents How to Invest in Stock Market Part 1. Friends, very much welcome to GAC Presents How to Invest in Stock Market Part 1. In previous session, we learnt about balance sheet and its components. In this session, we are going to learn about profit and loss account and its components. So friends, as on 1st January 2016, the company has been incorporated and it's ready to operate in the market. Suppose in first year, the company is able to convert all its raw material into finished good that has got a market value of 10,000 rupees. Company is also able to sell that entire finished good into the market and thus it earns a revenue of 10,000 rupees. Cost of that goods which has been sold in the market for 10,000 rupees comes to be 5,000 rupees, the same cost which we incurred to buy our raw material. This gives us our gross profit, which is our revenue minus cost of goods sold, which is equal to 5,000 rupees. But friends, that is not the only expense which company bears in selling its finished goods. Company also incurs selling general and administrative expenses, which are usually the rent expense, electricity expense, people hired to sell the product, salespeople, etc., etc. There are also some advertisement expenses. For the sake of simplicity, I have bifurcated these two expenses here. This advertisement expense is also generally a part of selling general and administrative expenses itself. So after deducting these two expenses, our gross profit, from our gross profit, we get earning before interest, tax, depreciation and amortization, which comes to be 4,500. Friends, our property, plant and equipment which the company has used to convert its raw material into finished good, not going to remain with the company for lifelong. Assuming that life of this property, plant and equipment is 10 years and the company uses straight line method to calculate the depreciation amount, for the sake of simplicity we have assumed that, then 10,000 divided by 10 gives us depreciation amount of 1,000 for 1 year, which we have deducted here from our earning before interest, tax, depreciation and amortization, which gives us our earning before interest and tax, which is equal to 3,500 rupees. We have also borrowed a loan of 7,000 rupees from the bank, which is going to charge us interest. We have assumed that the bank charges us an interest rate of 10%, which gives us our interest expense as 700 rupees, which would further be deducted from earning before interest and tax, which gives us our earning before tax, which is equal to 2,800 rupees. Assuming an effective tax rate of 30%, our tax calculation comes to be 840 rupees. 30% of 2,800 rupees of earning before tax. This gives us our profit after tax, which is also called net income. Friends, this income belongs to the shareholders. If majority shareholders decide that this amount should remain with the company for its further projects and development, then this amount goes to the equity as reserves and surpluses and forms a subhead of equity and would be reported in the next year balance sheet as reserves and surpluses adding with the equity. If the shareholder of the company, majority shareholders of the company decide that this amount or a part of this amount should be distributed amongst the shareholders, this amount would be divided as dividend to the shareholders of the company. In sum total, shareholders have got complete right, a complete say over this amount. So friends, this is our example of profit and loss account. So friends, in this session, we saw profit and loss account and its components. In our next session, we are going to see that how much cash company is left with after a year of operations. To know that, stay tuned with us. Also, to conclude today's session, if you like today's session, do subscribe to our channel, like and share its videos. This keeps us motivated to keep creating such videos. Once again, thank you very much.